Welcome to the Stock Market Palantir. Today we are going to talk about NGD.
We are, yeah. We're focusing on New Gold Inc. It's an intermediate producer that, well, it just made a definitive announcement about its all-share acquisition by Core Mining Inc. And this is a huge deal valued at approximately $7 billion. It just fundamentally changes everything for this company.
It really does. And I'd say it's more than just an acquisition. It's sort of a collision of two completely different narratives. I mean, NGD was right in the middle of this absolutely stunning, record-breaking operational turnaround. They were generating exceptional cash flow, proving the value of their assets, and then, bam, suddenly, they're locked into a merger.
Should its price be viewed through the lens of that impressive operational success? Or has it just become, a mathematical derivative completely defined by the merger arbitrage trade?
Right. And I'm going to argue that the operational performance, that free cash flow, the cost structure they finally achieved is the indisputable underpinning of value here. Kerr is buying a high-margin cash engine, and the timing just validates that high intrinsic worth.
And I'm going to argue that, that ship has sailed. The narrative for NGD now is purely technical. It's a derivative, as I said, tethered mathematically to the acquirer, CDE. The price movement today is dictated by arbitrage dynamics and market microstructure, not by how much gold they dig up at Rainy River.
Okay, well, to understand the premium that Core paid, you really have to look at NGD's operational story. It's a true inflection point. Core was, frankly, opportunistic. They're buying NGD exactly as its assets peaked in efficiency.
I see why you think that, but let me offer a different perspective. While yes, every acquirer wants efficiency, the moment that deal is announced, the focus shifts. It's no longer about operations. It becomes all about the closing mechanics.
I think that's a short-term view. The fundamentals set the price. Q3 2025, it wasn't just good, it was record-breaking. They generated $204.7 million in free cash flow. That is a 259% increase year over year. I mean, that kind of cash generation doesn't just change the valuation, it fundamentally de-risks the entire target.
The financial improvement it's undeniable. I'll grant you that.
Absolutely. The operational success, particularly at Rainy River, was immense. They hit record production over 100,000 ounces, and critically, this volume, this efficiency, it drove the company-wide all-in sustaining costs, the AISC, down to an incredibly competitive $966 per gold ounce. Just think about that margin when gold was trading in Q3 near $3,458 an ounce. They were just printing money.
And they use that cash flow well.
Precisely. NGD used that robust cash flow to repay $260 million in debt. So Core wasn't buying a struggling asset here. They were acquiring a perfectly clean, debt-reduced cash flow machine. The combined entity is now projected to achieve a massive $3 billion in EBITDA in 2026, and a disproportionately large share of that comes directly from NGD's assets. That operational strength, that massive FCF, that is the foundational rock of this $7 billion valuation.
Okay, I fully acknowledge the operational strength NGD brought to the table. It was a spectacular target. However, the definitive arrangement, an all-stock deal, it instantly put a hard ceiling and floor on NGD's value. It stopped being a pure gold stock and, overnight, became a math problem. My core thesis is that NGD is now anchored. This is a 100% stock-for-stock deal, and the fixed exchange ratio is 0.4959 shares of CDE for every single share of NGD. And that ratio, it's like a structural collar on NGD's stock price that just cannot be broken by operational news.
I'm not totally convinced operational news is irrelevant, but I agree the mechanism imposes constraints. So what does that mathematical constraint really mean for the average investor watching this?
It means the implied value of NGD is always, and I mean always, dictated by CDE share price multiplied by that fixed ratio. If CDE moves up 10%, NGD has to follow to maintain the spread. If CDE drops, NGD drops right with it. Any operational news, like them beating Q4 guidance, might have mattered immensely 3 months ago, but now It has almost zero immediate ability to break that fixed correlation. Look, as of late November, the market is pricing at a 2.37% gross arbitrage spread. That spread isn't random. It exists to compensate traders for the time value of money, because the deal won't close until the first half of 2026, and for any minor closing risks. The fact that the spread is so tight indicates extremely high market confidence that this deal will go through. The risk is structural, time and approval, not related to mine output or cost.
That's a powerful point on the structural risk. I'll give you that. But let's focus on the implication. If NGD is just a passive derivative, how do you explain the recent volatility? I mean, on November 26th, NGD rallied 6.67%. You're arguing this was just a passive reaction to CDE rising 7.43%?
Yes, I maintain that NGD was the reaction, not the cause. CDE rose because the macro environment supported this whole gold supercycle narrative, with spot prices over $4,200 an ounce. And CDE's high beta just amplified those metal price movements. NGD is just passively tied to the mast of the CDE ship. The correlation is near perfect, and the driver originates with the acquirer.
Okay, I acknowledge the near-perfect daily correlation, but we have to ask why. Why is CDE trading with such high sensitivity, with such a high beta? I would argue that CDE is valued so highly, and its stock is now so incredibly sensitive to the metal price precisely because they are acquiring NGD's assets, which deliver massive cash flow leverage. Think about that incredible margin again. In Q3, NGD was delivering a profit margin of $2,492 per ounce. That's the realized gold price minus their AISC. A margin like that is almost unheard of in this sector, and it explains everything. The gold rally simply amplifies the immense operational profitability that Core is buying. Without NGD's high-margin assets, CDE wouldn't be rallying as strongly. The intrinsic FCF generation is the real reason CDE's stock acts as such a powerful lever on the gold price.
And that is a compelling line of reasoning for the initial justification for the acquisition price. I agree. Fundamentals set the initial value. However, the current trading price is now governed by the arbitrage calculation and CDE's inherent volatility. The NGD shareholder isn't betting on Rainy River's tonnage anymore. They are underwriting CDE's commodity exposure until the deal closes. NGD's specific quarterly output is, for today, irrelevant to the price, because that ratio is locked. If gold falls tomorrow, NGD falls, even if their operational report is stellar.
Well, that moves us directly to the market activity then, specifically the institutional activity. If NGD is just a derivative, how do we interpret the elevated off-exchange short volume ratios we've been seeing?
Right. If you look closely at the data, the off-exchange short volume for NGD, which often exceeds 40% and even peaked over 51% on November 19, that is the clear signature of sophisticated merger arbitrage desks. This is misunderstood by so many retail investors as some huge bearish signal, but it is purely 100% technical.
Okay, can you walk us through the mechanics? Why does an arbitrage trade result in such a high reported short volume?
Certainly. So these arbitrage desks, they're trying to lock in that small 2.37% spread. The classic play is to go long NGD and short CDE. They buy huge blocks of NGD and simultaneously short the proportional amount of CDE to hedge out all the market risk. And to minimize the price impact of these massive trades, they're often executed in dark pools or alternative trading systems. So when a market maker facilitates a massive long NGD trade for a hedge fund, that market maker has to hedge their own exposure. They do that by shorting NGD themselves. This shorting activity gets reported as high short volume in the off-exchange data. It's transient shorting. It's hedging the long side of the ARB trade, not a directional bet against NGD's future. It's crucial to see it as technical and non-directional.
I appreciate the clarification on that, but let's use a simpler measure, the days to cover ratio. What does that tell us here?
It's the clearest indicator. The days to cover ratio is extremely low. It's often around 1 day. This means that if every short seller suddenly decided to cover, they could do so in about a single day's worth of trading volume. A high days to cover ratio might indicate a short squeeze. A low ratio like this just confirms there is no real structural directional short interest against the stock. It's pure technical hedging, which confirms the stock is now totally dominated by the merger arbitrage trade.
Okay, while I accept the technical explanation, I think the institutional activity still provides a kind of validation. The fact that sophisticated money is consistently executing this complex strategy just to lock in a tiny 2.37% spread, that demonstrates something powerful. It shows institutional confidence in the completion of the deal. They are comfortable underwriting the execution risk because they trust the fundamental value set by NGD's assets.
That's an interesting way to frame it, though. I'd argue their confidence is more in the transaction mechanics. The regulatory hurdles are low. The shareholder votes are highly secure because of pre-existing support from directors and officers. Their confidence is in the deal itself, not necessarily in the day-to-day mine operations.
Well, let's pivot to the shareholder perspective then, which brings up retail sentiment and, frankly, a lot of confusion. We definitely saw a sell the news reaction right after the announcement.
That disappointment was palpable. Retail momentum traders were used to NGD acting as this high beta play on the gold price. A 16% premium seemed paltry to them when gold had been soaring. They felt they were being forced to give up all this potential upside for an acquisition that locks them into CDE's execution risk.
Exactly. The lack of a cash component forced NGD holders to effectively underwrite CDE's future market risk. This emotional reaction, this desire for immediate certainty, it created unnecessary selling pressure from those momentum traders, even if the arbitrage math suggests the stock's value is pretty secure.
And this retail confusion ties into a specific, persistent rumor that we need to address head on: the misunderstanding about reverse stock splits.
Yes, that rumor is everywhere, and it's causing needless anxiety. So let's be explicit. New Gold, NGD, has not executed a reverse stock split recently.
We need to explain why this confusion exists. It stems from people either confusing NGD with other similarly ticketed stocks that have done splits, or they just misunderstand the merger conversion itself. That 0.4959 exchange ratio. That's the source of the trouble.
Correct. Mathematically, receiving roughly half a share of CDE for every share of NGD means shareholders are converting their holdings at about a 1-for-2 ratio. It functions mathematically like a mandatory share consolidation. So, to the less sophisticated investor, this feels like a reverse split, which is a concept they often associate with troubled companies.
Right, and we have to clarify that this is merely the fixed ratio dictating the future share structure of the combined company. Now finally, while confidence in the deal closing is high, we do have to acknowledge the last remaining risk vector, the shareholder vote requirement.
The requirement for a 66 2/3% NGD shareholder approval. And while it's low risk because of institutional support, that mandatory approval plus the time it takes to close in H1 2026 is precisely why that 2.37% arbitrage spread is still alive. If the deal were 100% guaranteed tomorrow, that spread would vanish instantly.
So the core dichotomy remains. We have a fundamental asset acquired at peak operational efficiency, generating massive FCF, but its current trading price is mathematically constrained by an arbitrage function until the deal closes.
And I'll reiterate that the operational excellence, that $2,500 margin, is why the combined entity can project $3 billion in EBT day. That intrinsic value is the foundation, and while the price might be tightly tethered to CDE today, the foundational reason for the value and the confidence institutions show in the deal closing all comes back to NGD's operational success.
My position remains that for current NGD shareholders, the investment vehicle has been fundamentally altered. Price action will remain tightly correlated to CDE and the broader gold macro market until that closing in H1 2026. You are no longer owning a mid-tier producer with operational risk. You are owning a derivative of CDE at a fixed ratio with transaction risk.
This discussion really highlights the complexity you find when you analyze merger targets, especially where genuine, record-setting operational success meets the rigid, unforgiving constraints of financial arbitrage. We've explored the foundational value from NGD's free cash flow and the undeniable mathematical reality of that fixed exchange ratio.
And the ultimate question for an investor is, which constraint weighs more heavily? The deep underlying intrinsic value that set the purchase price in the first place, or the mathematical anchor that governs the daily price action and volatility from here on out.
And hopefully, we've also clarified some of that widespread retail confusion and explicitly debunked the rumors of a reverse split, attributing that to the admittedly complex nature of the stock-for-stock exchange.
Right before ending the podcast audio with a summary of the discussion. Thank you very much for hearing us. Let us know in the comments what is your opinion. And if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stocks insights, and see you in the next video.